When running an S Corp, setting the right salary for yourself is crucial, not just for compliance, but also for managing your tax responsibilities wisely. You've probably heard that the IRS expects owners to pay themselves a reasonable salary, but pinning down what that means isn't always straightforward. It's a key step to maximize benefits while avoiding trouble down the line. Imagine you're the owner of a small business operating as an LLC that elected to be taxed as an S corporation. The goal is to reduce your overall tax load, which makes understanding how to determine and pay yourself effectively so important. Your salary impacts employment taxes, while distributions can be more tax efficient, but the IRS keeps a close eye to prevent abuse. If you pay yourself too little or structure things improperly, you risk audits, penalties, and back taxes. So, what exactly does reasonable salary mean? The IRS looks for pay that mirrors what others in your industry, location, and role are earning. Essentially, it should be comparable to what someone doing similar work earns in your area. For instance, if a digital marketing professional in Portland averages about $60,800 annually, your salary should be in a similar range, adjusted for experience and responsibilities. Avoid the trap of casual rules like the 60-40 split. Claiming 60% of revenue as salary and 40% as distributions may seem simple, but it's not a reliable method. The IRS prefers that you base your salary on actual market data and your job duties. Missteps here can lead to IRS scrutiny, resulting in misclassification of income or even reclassification of distributions as wages, along with penalties. Gathering accurate data is easier than you think. Resources like Glassdoor or the Bureau of Labor Statistics provide up-to-date salary info on various roles in specific areas. You might also consider consulting with a compensation expert who can analyze trends and help you set a fair figure. Now let's clear up a common misconception. Some think you don't need a salary if your profits are low or if you haven't taken distributions yet. The truth is, the IRS expects owners to pay themselves an appropriate wage based on their work, regardless of profits, especially if you're actively managing the business. Paying yourself a salary involves proper procedures, withholding the right taxes, issuing a W-2 at year's end, and making quarterly tax filings. It's not just about compliance, but also about ensuring the tax-saving strategies work as intended. Your business will need forms like the W-2, Schedule K-1, and the 1120S tax return annually, along with quarterly reports for payroll taxes. For example, if your net profit is $125,000 in a Portland-based marketing firm and the local average salary is around $60,800, paying yourself roughly that amount while taking the rest as distributions makes sense. On the other hand, if you're earning $70,000 in profit as a programmer in Los Angeles, but the typical salary for similar roles is $76,150, you might need to adjust your salary upward to meet IRS standards rather than relying solely on distributions. Deciding whether an S corporation is right for your business depends on your income level and profit margins. If your earnings are high enough that separating a decent salary from distributions offers real tax savings, it can be worth it. Just remember, maintaining proper documentation and paying close attention to IRS guidelines helps avoid unnecessary issues. If you're considering this path, working with professionals like accounting experts can make a big difference. They can help you interpret the rules, establish fair salaries, and handle filings accurately. Want to make sure you're on the right track? Reach out to FilingFox at info@filingfox.com for guidance tailored to your business. We're here to keep things simple and clear. Thanks for watching. If you found this helpful, hit that like button and subscribe for more insights. Good luck with your business growth.